Hi, Ayra. How are you? I have another video for you today. So today I want to discuss money creation and how it impacts so many things that we don't really realize. And here I want to take an example of a farmer in some remote village of India. They know a lot about agriculture. How does, let's say, US is printing new money? How does that impact her very drastically so, right? It impacts in how much her fertilizer costs, how much her seeds cost, how much she'll make for whatever produce that she has gotten. It even impacts what she buys and how much she pays for what she buys. When a country that is thousands of kilometers away, miles away, is doing something, and most of the time we don't know that is happening, right? And but it still impacts her. So today I want to talk about how money is created to begin with, right? Oftentimes we think governments print new money, or here in India we have RBI. In the US there is federal bank, right? So RBI prints physical money, and then that gets sent to banks somehow, and then banks send it to people somehow, or people get salaries somehow. We don't usually have a very crystal clear picture of how new money is printed or created and gets distributed in the economy. There's really two ways that new money is created. One is the government every year releases a budget of how to spend for different categories, for education, for transportation, all of those things. And most of the times they spend more than they already earn. So where does the extra money come from? Is it comes as a loan or as additional money from the government, from the RBI. So that gets into people's hands as salaries or all those things. So this is a very common way that we know of. The second way, which is more common than the first way and more prevalent, is loans. And that is done by banks, not by the government, not by RBI, the regular banks that people visit and take loans from. When you go to a bank to get a loan, and the bank gives you, let's say, 10,000 rupees, the bank doesn't need to have those 10,000 rupees. All it does is it creates two inputs in its software. One is create an account for Anu and show balance as 10,000 rupees that he can use, and create another input in the software where Anup has to give the bank 10,000 rupees back on a certain date, maybe with interest, right? Here, the bank doesn't need to have that 10,000. It just needs to make those two entries in its software. This sounds completely absurd, but this is exactly what happens. So every day a bank is giving out a new loan, new money is being created. Now, what happens when you send that money from your account to somebody else's account? If that somebody else's account is within, again, the same bank, let's say in this case ICICI, they just reduce the number that was in your account and increase the number that is in the other person's account within their software. Nothing has to happen outside of their bank. But if you have to send that money outside of your own bank to someone else's bank, what actually happens is your bank has to go to RBI, and your bank has an account at the RBI and has some balance in it that is called reserves. It has to take some money out of those reserves, whatever you want to send, and send it to the reserves of the other bank that you are just trying to send the money to. And that money goes into the reserves of that bank. Once that bank receives that money in the reserves, it will then check, okay, whose account should I increase the number in now? So on any given day, a bank doesn't need to have all the money that it is giving out in loans or all the money that was deposited in it. It only needs to have whatever is the amount of transactions that might happen in that day is the only amount that they need to have, and maybe a little bit more to make sure that there is no fluctuations. That's all, and that number is called reserve. Sometimes banks collapse, right? What happens in those days is all of the people who have account in a given bank come to the bank and say we want all of our money back. But the bank doesn't have it. The bank only has the expected amount of transactions money saved in those reserves with RBI. So this is how new money is created. But why does US bank creating new money affect a farmer in India? Because of trade, because of what's called currency exchange. Generally, we know that when you exchange one currency for the other, let's say US dollar to Indian currency, there is a certain number you need to pay. For example, right now, $1 to get $1, you need to pay 95, 96 rupees. Right? Earlier, maybe 10 years ago, it was 50 rupees. 10 years ago, before that, maybe it was 30 rupees. Right? So why does this keep increasing? Because of trade. What do you mean? It means when, let's say, we as India want to buy products that are not made in India, that are made somewhere else, right? To get that product, we need to pay whoever is producing that product in the currency that they want to be paid in. We can't just pay them in any currency that we want to pay them in. And typically, there are 4 or 5 currencies most countries want to be paid in, and the first in that is US dollar. Most of the things that we buy, we pay for in US dollars. And the biggest thing that we buy is oil, crude oil, that powers so many things, that is tied into so many things that India does, that we don't often realize. We think, yeah, okay, petrol prices have increased, diesel prices have increased. Not just that. So many things change because of it. So now the more and more oil or imports that we want to do, we need more and more dollars. So when we demand more and more dollars, the price per dollar that we need to pay keeps going up, because whoever is giving us dollars, which is the US bank right now, asks for more and more rupees to get those dollars. So 20 years ago, they asked 30 rupees to get $1. Now they need 96 rupees. But why is this the case? Because they don't need rupees to buy stuff. That's why, if they needed rupees, if rupee was in demand, if they wanted to buy so many products that were made in India, then we could say, hey, you're asking for too many rupees. I need more dollars per rupee. I can't just keep giving you as many rupees as you want. I need more dollars. So when products that are made in India are needed outside, are wanted outside, then we can say, hey, I want to be paid in rupees, and I'll only take these many dollars for a rupee. So that is how currency exchange is decided, purely because of trade. And this is true for any country, right? So for any country, there are 2 things that they can do, or 3 things, right? One is import as much as they export, so that it is balanced, or export so much and import so little, so your currency is at higher value, higher demand, right? Or the worst case scenario is you keep importing so much and you don't export anything. That is when countries get into danger, because you keep giving more and more of your currency until a point where it doesn't become realistic. Everything becomes so expensive that you just don't have any products. That is how currencies fail. Now here, one interesting thing. For US though, when they want to buy a product that is not made in the US, which currency do they pay them in? Typically, their own currency. Because all countries want US dollars. Why do all countries want US dollars? Because through decades, almost 50 years now, and even before that, US has made sure that people need, want, and trust dollars. How did the trust part come in? After World War II, they sat with so many countries and said, hey, let's agree on using dollars, and what I'll do is I have so much gold reserves, highest in the entire world. So tomorrow, if you don't want to keep a dollar that you have, you can come back to me and give that dollar, and I'll give you a certain amount of fixed amount of gold, so that you can keep the gold that you want. Until then, gold was the major reserve. And people were like, yeah, this makes sense. You have the most gold, and we'll keep using dollars, so it's stable. And whenever we want it, we'll give back. But what happened is US kept printing so much money, because it kept importing so many goods from outside, kept printing money. And people are like, hey, you're printing too much, just give us our gold back. And everybody started coming in, just like the initial bank scenario that we talked about, right? And one fine day, US realized, okay, this is not working. So they woke up and said, around 1971 or 72, something like that, said, we're not converting dollars to gold anymore. That deal is done. And everybody was like, what is going on? But they didn't have a choice because either all of them had to collectively decide on something else or just keep using dollars. So now they continue to use dollars, but there is no safety. So they just have to trust. Now that cannot continue forever, right? So eventually they'll come up with something else. But here again, the US did something very interesting. In 1973, it made a deal with Saudi Arabia saying, you have the most oil reserves in the world and everybody needs oil. Let's agree on a deal. I'll give you all my military protection. I have a lot of military protection. So I'll make sure that nobody comes in and invades so that they can take your oil. But in return, you need to do a favor. You need to decide that you will sell oil only in dollars. You will not accept any other currency. Saudi Arabia was like, yeah, this is fine. Makes sense to me. Let's do it. Right? Now the US made sure that instead of gold, which you couldn't use for anything, it's just sitting there, it's a reserve, it's safe. Now everybody needs oil, so it is getting consumed, and you can only buy oil in dollars. So no matter how much the US prints, people needed it, so people kept absorbing. So that is how the demand for dollar kept rising, and all the currencies are weaker, most of the currencies at least are weaker than a dollar. So you have to pay more in your currency to get a dollar. Why is oil so important? What makes a difference, right? Or why is trade so important? Why is exports and imports so important? Most of the energy, our electricity, our transportation, and the plastic that we use, that needs oil. So many industries, heavy industries, the steel industry, for example, so many heavy industries are either powered by coal or oil, and most of it we keep importing, right? Which means the day somebody stops selling oil to us, or the day we run out of dollars to buy oil, our entire economy stops. Or even if it doesn't suddenly stop, what happens when it keeps getting more and more expensive? Whoever is making a product or whoever is shipping a product, right? Let's say you make a shirt and you want to send it somewhere else, but initially you made the shirt for 100 rupees, the transportation cost was 10 rupees, so you sold it at 150 and you got 40 rupees profit, fine. But now, because oil became 10 times more expensive, transportation became 100 rupees in itself. So now the overall cost to you is 200, but you have to sell it at 150, doesn't work. What you do, you raise the price, becomes 250. Shirt is not related to oil, but it still got expensive. That's not the only thing. When we keep importing more and more dollars, we pay more per dollar, right? And that rate stays the same for everything, not just oil. Tomorrow, if you want to buy a TV, earlier you were paying 50 rupees per dollar. Now you have to pay 60 rupees per dollar, 90 rupees per dollar to buy the same TV. Even though the TV might not have increased in price, it's probably still $100, right? But now, instead of paying 5,000, you're paying 9,000. Tomorrow maybe 10,000, right? So TV is not related to oil, but it's related to a dollar. So that got more expensive. And you know what is interesting? India is known to be an agriculture-based economy, right? 50% of our population is in agriculture. 70% of India is rural, right? What is interesting is we import agricultural products as well. We import fertilizers that we need to grow our plants. I mean, we have natural organic ways of making fertilizers, but for some reason, we import fertilizers. We import grains, pulses, dal. We are the biggest producer of dal, but we are also biggest importer of dal. We import cooking oil, vegetable oils, and we are paying for them in dollars, and we're paying more and more rupees per dollar. So now think about that farmer. That farmer needed fertilizer. That fertilizer was imported. She doesn't know that. She is just probably going to a local shop and buying it. Right? But US printed more money. So now that fertilizer itself became expensive. Earlier it was $100 per kg. Now they're selling it at $110 per kg. And rupees also lose weakening, which means now we need to pay, instead of paying 50 rupees per dollar, we need to make 90 rupees per dollar. So now not only did the bag itself get expensive, dollar also got expensive. So now earlier when our farmer was paying, let's say, 1,000 rupees to get some fertilizer, now she has to pay 2,000 rupees. She doesn't know why when Russia and Ukraine are in war. She doesn't know why US and Iran are in war. But that increased the price of oil. And interestingly, right, because we also import LPG, right, the cooking gas that we use in our homes, that got more expensive. Now, so many people, at least in cities in India, right, depend on home delivery for so many goods. And the people who are working as these delivery agents, right, typically are migrants from different villages coming into the city to make a living, right? But now they don't have access to gas. They can't cook in the cities because they're unable to find gas, and it's becoming more and more expensive. So what do? They go back to their home villages where they'll figure out ways to cook and ways to live. Now there's no delivery agents for you. So now even that got more expensive. Delivery was not related to oil. At least people were not related to oil. But that got more expensive. Our packaging things got more expensive. And you know what's interesting? Out of all of this, right? US printed money, things became more expensive. Right? There's war, things became more expensive, we are paying more, and farmers getting fine. Forget all of this, right? We're not printing new money, we're not going to war. Let's just talk about structure of the economy. When a bank gives you a loan for certain percentage, for 10%, 5%, whatever, right? What does that percentage mean? It means the bank is giving you 100 rupees today, but you're expected to pay back 105 or 110, right? But where does the extra 10 rupees come from? Is somebody else creating extra 10 rupees? No. It has to come from the existing money. What does it mean? It means you have to somehow figure out to collect more money from other people, which means these other people are now have 10 rupees less, right? Now think about this. You do this enough times and you're essentially trying to concentrate or pool all of that money into one single place. Or in order to not reduce the money that they have, what these people have to do, the rest of the people, is they also take new loans to make sure they are able to pay for whatever product you're selling. So that's why you see we have installments to buy a sofa, we have installments to buy a car, we have installments to buy a phone, because we are expected to collect more and more money. But where does that more and more money come from? Either all of the people have to give the money to some person, some single person, so that money is concentrated, but the rest of them starve, or they need to keep taking new loans to then keep paying for the products. It is an endless cycle. This is essentially how money works. And now think about companies. When companies take a loan, they need to also pay it back with more interest, right? Which means they need to figure out how to pull in money from their customers, which is fine. That is how business is done, right? But now think about people's salaries, right? So farmer is one side. Let's take a regular salaried employee, right? Yeah, things are getting expensive. People are taking loans. There's more money. There's all of those things. Isn't salary increasing? Not really, because if products get more expensive and salary increases at the same rate, the company's profits are not increasing. So, and this is not to blame any company, right? This is the entire structure that we are living in right now. What is the solution? I am not sure. This is how the economy is working, but I'm just amazed at not realizing all of these connections before, right? And this is not to say that, people are bad, they have bad. No, this is just the structure that we are talking about. So all of these things having been said, how does this farmer make sure that agriculture doesn't become more and more difficult for her, right? Or how do I, as a salaried employee, make sure that life doesn't become more and more difficult for me? Or how does a country make sure that their currency doesn't get devalued, or they're not uh, critically dependent on so many basic needs, right? Think about this. So now that we have all of this awareness, let's make sure we can make our own fertilizer, right? We have so many organic ways. You do composting, right? Or let's make sure we're able to generate energy from renewable resources, whether it's solar, whether it's hydroelectric power, right? Let's make sure our transportation is dependent more and more on sustainable energy sources. Do a little bit of research, see what you come up with, see where the connections happen, and see where do you think we can build new solutions. That is the whole goal. Let's pay more attention to these things and understand how the structure is built and how we can truly make the structure better so that we as a civilization, we as humans can live better.